Hello folks, Steve Lance here with Discover Options and Option View. Welcome to this presentation of several different timing reports for advanced options traders. This is for Friday ending July 14th, 2017, getting ready for Monday, the 17th. Gotta get my dates right. It's Saturday. All right. And so presented material is for educational purposes only. It should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Okay, so we have three timing reports for you. Before we get right to these, I want to make sure that you understand you can get a free e-trading book co-authored by Jim Graham and myself. To get that, just click the link, give us your information, and we'll get you that free e-trading book. Also, we'd like you to subscribe. That way you can get alerted whenever we have new recordings come out. Just click the subscribe button. We would love to have you get those alerts. Those reports all look at the current market condition. Let's take a look here at the SPX. The SPX, and we defined current market condition in three different ways: a combination of price action, trend, and then the overbought, oversold stochastic indicator. So in terms of price action, Thursday was an upswing bar where you had a higher high and a higher low. And then on Friday, we had another upswing bar. Two consecutive upswing bars occurring above the 50-day simple moving average and with the 15-3 stochastic between 60 and 100 above the 3-day simple moving average %D. All that makes for a market condition that has occurred quite often, over 540 times since Jan of 2000. So this market condition has occurred a lot. We have some good statistics on it. So stand by and let's go through these timing reports. First of all, for those of you that like to sell option premium using condors and butters, let's take a look at the Condor and Butterfly timing report. So since Jan of 2000, there have been over 4,300 daily closes of the SPX. Now, of those, 65.4% have been favorable bars for selling premium, option premium, where the actual 21 bar movement, after that, turns out to have been less than what was implied by the SIBO skew adjusted implied movement through the VIX. Okay, so you could flip a coin in the past for those 4,300 over 4,300 instances. Okay, all those closes, and of those coin flips, 65.4% would end up being bars that were favorable for doing condors and butters, where the ensuing movement was less than what was implied by the option prices. Okay, so that's the benchmark. That's the baseline level of favorableness. Now, also during that time, our current market condition that I just described, okay, has occurred 541 times. Now, of those 541 occurrences, 71.5% ended up being similarly favorable for option premium selling. So this implies an edge of a little over 6%, because of those 541, there's a greater percentage of those that were favorable than what you see in just benchmark baseline flipping a coin randomly in the market. Okay, so there's about a 6% edge given this market condition for selling premium neutrally through condors and butters. Okay, and so that's the Condor Butterfly timing report. Now, some of you like to do similar strategies using bull put spreads, or maybe you're doing condors where you're leaning at bullish. Maybe you're doing those out of the money put butterflies where you're leaning at bullish. So here's the report for this. And when we're basing this on selling put premium a standard deviation away about 30 days out. That's the presupposition here. So since Jan of 2000, like I mentioned, we've had about 4,556 days of closing days of the SPX. Now, of those, almost 83%, 82.9% have been favorable bars for selling that kind of put premium, where the actual 21 bar downside movement going towards those puts, the actual 21 bar movement to the downside was less than what was implied by the SIBO skew adjusted movement implied, okay? And so we're selling puts a standard deviation away 30 days out. The market fails to go down and hit that short strike at that point 82.9% of the time. It fails to do that. It hits it on average, randomly about 17% of the time. Okay, now let's take a look at our market condition. Out of 541 times, 86.5% of those have been similarly favorable, where the downside movement was, less than what was implied. Okay, so that implies then a put premium selling edge of roughly 3.6%. 3.6%. So statistically, it's more likely than usual that Friday's bar will end up being favorable for selling out of the money put premium 30 days standard deviation away. Okay, so that's the bull put spread timing report. Now, let's get to the likelihood report. This is where we're going to ask ourselves the question, given the market condition we see today, is the market likely to go up, down, or wobble around for a bit? Okay, and we need to have some kind of measurement there, some kind of way of measuring price distribution. So what we do is from every close, we measure 6 different levels. 3 little levels to the upside and 3 to the downside, 5, 10, and 15 days out. I call these distribution bands. And these are determined by the SIBO skew adjusted VIX. And that's what you see here, upper 5, 10, and 15. Okay, 5, 10, and 15, and a lower 5, 10, and 15 day band. So let me just give you an example of this in real time here. So let me do this just a second. Boom, click this. All right, it's not clicking off. How about escape? There we go. Let's take a look at this first distribution band. These are the 5-day bands, set 1 standard deviation away from the close. Notice that the upside band is closer to the close than the downside band. And this is the skew adjusted part of this. Out of the money call options have a lower implied volatility than the out of the money put options. And that's reflected here, where the upside band is closer to the close than the downside 5-day band. And so what we want to know then is, over time, how often do these 5-day bands get struck within 5 days? Will price go up and hit this level within 5 days, or go down and hit this level within 5 days, or hit neither of them? All right, but we do this measurement for the 5, 10, and 15-day levels. And when we go to the report, okay, what we see then is that out of the 4,356 occurrences, the upper 5-day band was hit 21.4% of the time, the upper 10-day band 15.9%, upper 15 14.9%, now the lower side 16.6%, 16.8%, 19.6%. So this is the baseline percentages that these bands get struck within those respective days. Now, let's go to our current market condition. Okay, our current market condition occurred 292 non-consecutive times. When you throw in the consecutive incidences, then you get up to 541. So these are unique incidences where it does not occur just prior to. Okay, these are 292 non-consecutive occurrences. Of those, the upper 5-day band got struck just a little over 9% of the time, not 21, but 9. So that upper 5-day band is getting struck significantly less often under our current market condition. The upper 10-day bands were struck quite a bit less often. The 15-day bands to the upside less often. Look at this. All 6 of these bands are struck less often than the baseline. Interesting. That's a picture of lower market volatility, both to the upside and the downside. And I don't see this thing leaning bullish or bearish like it can sometimes. Obviously, if you have one side getting struck more often, well, that would, tell you that you have a directional bias there. In our case, in almost all incidences, here's one that's about a scratch, but in all incidences, whether the market goes above the Friday's high or exceeds Friday's low, you're seeing lower market volatility across the board. Interesting. Okay, so that's what we get from the likelihood report. This shows that there's a significant likelihood that the market will be less volatile than normal after this market condition has occurred, like it has. What else about this? Anything else? Now, does that mean that we will have a less volatile market? Well, certainly not. These bands can get struck occasionally. Look at this. I mean, you do have, and it's under 10% in many of these cases, but there is a chance that one of these bands is going to get struck, and that would be a move of a greater than a 1 standard deviation level. It's just simply that looking back in the past, statistically, it would not appear that it's likely, or certainly it's less likely to get volatile, and it's much more likely that it will be have a market that is much lower volatility than we're used to. Okay, so with that said, want to wish everyone good trading, and we will be back next week with another set of timing reports. Thank you for joining me. I'm Steve Lentz with Discover Options.